the second session of our discussion. At the end of the first session, we began exploring the three layers of this research that are of interest to many countries. These layers include first, demographics. This encompasses key aspects such as fertility rates, the proportion of the population aged 80 and older, and the obligations tied to entitlement programs designed to support the elderly. Demographics form the foundation of any economy, as they directly affect the availability of workers and the economic structure. Dusra, migration. Macroeconomics. Migration isn't merely about individuals deciding where to live or work. In many countries, foreign workers fill critical labor shortages under specific arrangements, such as work permits. For instance, Japan relies heavily on foreign workers to care for its aging population. Migration economics also examines broader macroeconomic implications, such as housing developments for migrant workers and the role migration plays in sustaining economic growth. Mundram technology. Advancements in artificial intelligence and robotics are reshaping industries, including caregiving, particularly in aging societies like Japan. As we enter an era where AI is increasingly leveraged for labor-saving applications, how nations adopt and integrate these technologies will be pivotal for global development. In our previous session, we delved into models with endogenous money creation and financial stability, emphasizing their importance in understanding modern economies. Virtually every contemporary economy operates within a sophisticated financial system, making it essential to understand the actual role of commercial banks. Contrary to standard textbook representations, banks do not simply collect deposits to lend them out. Instead, the process begins when individuals or businesses approach banks for loans, such as mortgages for home purchases. Many commercial banks specialize in specific types of loans, such as mortgages or car loans. When a bank grants a loan, it creates purchasing power by recording a corresponding liability on its balance sheet. This endogenous process of money creation significantly impacts economic dynamics, including the subsequent actions of borrowers, whether they reinvest or repay debt. To illustrate, let us consider the financial system leading up to the global financial crisis of 2008. In August 2008, new loans, particularly mortgages, were being granted in significant quantities in the United Kingdom. These loans often featured high loan-to-value, LTV ratios such as 85% or even 95%, meaning borrowers were financing most of the property's cost. The spread, or the difference between the mortgage interest rate and the bank rate, was notably low, reflecting an underpricing of risk. This was particularly evident in loans with higher LTV ratios. However, following the collapse of Lehman Brothers on September 15, 2008, the financial landscape changed drastically. By August 2009, banks had curtailed their issuance of risky loans, causing a significant reduction in the volume of high LTV loans. The spreads on these loans also increased as banks sought to repair their capital positions and mitigate risk. Less risky loans, those with LTV ratios of 65% or lower, remained more accessible, but even these saw a moderate contraction. As the economy began to recover in 2009 and 2010, credit availability gradually improved. While the riskiest segments of the mortgage market, 95% plus LTV, showed some recovery, they were accompanied by higher interest rate spreads to reflect the reassessment of risk. By 2011, the market had expanded further, signaling a continued economic recovery, though risk pricing remained more prudent compared to the pre-crisis period. This progression demonstrates how financial institutions adapt to crises and recalibrate their risk management strategies. The data from the United Kingdom during this period provide valuable insights, as they capture both the volume of mortgage products and their corresponding interest rates. This section builds on our earlier discussion by examining the consolidated balance sheet of commercial banks. On the asset side, banks hold loans and securities, both of which carry inherent risks. For example, during the COVID-19 pandemic, 30-year jumbo mortgage rates dropped to historic lows, reaching 2.8%. If these rates subsequently doubled, banks would face significant capital losses on such low interest rate loans and securities acquired during that period. This highlights the risk associated with the asset side of the balance sheet, particularly in an environment of rising interest rates. Federal Reserve Chair Jerome Powell recently commented that this issue does not pose a crisis on the scale of the global financial crisis, GFC. While this may hold true in terms of interest rate risks' direct impact on commercial bank balance sheets, it overlooks larger macroeconomic risks stemming from the household balance sheet. Since the first quarter of 2020, the value of household assets, both financial and non-financial, has increased by a staggering $43 trillion. During the initial COVID lockdowns in early 2020, equity prices dropped as expected. However, unprecedented monetary and fiscal policy measures drove real interest rates into negative territory, fueling a sharp rebound in asset prices. The S&P 500, for example, has surged by over 116% since the trough of 2020. This dramatic rise in asset prices occurred despite a decline in cumulative nominal output during the pandemic, driven largely by the lower real interest rate environment. Although real interest rates have adjusted somewhat, the broader implications extend beyond the valuation effects on commercial bank balance sheets that Powell has emphasized. The current asset price bubble is much larger than the one preceding the GFC. Housing prices, for instance, have risen by approximately 50%. This creates significant risks, particularly if consumption, closely tied to real disposable income and asset values, remains elevated. Housing, a critical component of consumption, is typically financed through credit. If asset prices remain high, they may drive increased demand for consumption and housing services, potentially leading to higher leverage in the coming years. This scenario poses a dual risk, an asset price bubble accompanied by excessive credit expansion. While we currently observe the asset price bubble, excessive credit expansion relative to nominal GDP or disposable income has not yet materialized. However, caution is warranted when interpreting credit to GDP ratios, as nominal GDP itself is supported by high asset prices. In adverse conditions, a decline in nominal GDP could worsen credit metrics. The outdated loanable funds model, still prevalent in many textbooks, views banks as mere intermediaries that collect deposits and lend them out. This perspective is both misleading and dangerous. Modern financial systems operate on the principle of endogenous money creation. Banks do not wait to collect deposits before making loans. Instead, they create money when they identify profitable, low-risk lending opportunities. This framework is crucial for understanding the dynamics of asset price bubbles and credit expansion. While some financial institutions, such as mutual funds or pension funds, operate on a loanable funds model, commercial banks are fundamentally different. Institutions like life insurance companies collect deposits and invest them on behalf of clients, adhering to regulations that govern their operations. In contrast, commercial banks play a unique role in endogenous money creation, which shapes economic outcomes in profound ways. To grasp the implications of this system, it is essential to adopt the endogenous money creation framework. Failure to do so leads to a backward understanding of financial systems and economic dynamics. For further insights, I recommend viewing the content produced by Shalwa, head of the Monetary Policy and Research Department at the National Bank of Georgia. His YouTube channel provides excellent explanations of monetary policy and financial stability from a central banker's perspective. This concludes our exploration of endogenous money creation from the perspective of the bank balance sheet. Next, we will examine its broader implications for the global economy. In traditional loanable funds models applied to global closed economies, it is challenging to explain the strong correlation between investment and consumption. These models assume that saving equals investment, which constrains how we conceptualize financial cycles. Under this framework, significant investment cycles, such as overinvestment in the housing sector during the global financial crisis or in China today, are attributed to high saving rates. This is because in such models, someone must sacrifice consumption to enable investment, as saving must always equal investment. In contrast, modern financial systems are not bound by this rigid constraint. Here, individuals or businesses with innovative ideas, such as artificial intelligence or historically electricity, can obtain loans from banks to finance investment. This enables simultaneous increases in both consumption and investment, as both households and businesses can borrow to fund expenditures. This flexibility explains the high correlation between investment and consumption observed at the global level and underscores the necessity of models incorporating endogenous money creation for a more accurate understanding of the global economy. A virtuous credit cycle occurs when investments funded by loans generate positive economic outcomes. For example, consider entrepreneurs investing in artificial intelligence or robotics. They borrow from banks to hire workers and purchase technology, which increases incomes across the economy. Workers and technology suppliers benefit, driving higher consumption and investment. As the economy grows and prospects improve, banks become more willing to extend additional credit, reinforcing this cycle. This creates a self-sustaining economic expansion, often retrospectively described as virtuous, where access to financial markets and confidence in future returns enable more consumption and investment today. Conversely, a vicious credit cycle emerges when investments fail to deliver promised returns. For instance, if artificial intelligence or machine learning applications are overhyped and fail to generate meaningful economic value, banks may realize that their loans were based on flawed assumptions. This leads to a tightening of credit, declining incomes, and reduced consumption and investment. Such scenarios are currently unfolding in China, where banks face deteriorating balance sheets filled with bad assets, particularly from over-leveraged developers. The subsequent tightening of credit exacerbates economic decline, reinforcing the downward spiral. Just as virtuous credit cycles can drive economic growth, vicious cycles can cause significant economic contractions. Modern financial systems must address financing constraints related to endogenous money creation. These constraints involve three primary uses of money: nominal consumption expenditures. Households require purchasing power to finance daily consumption. Financing new investments. This includes expenditures on new housing or physical capital, represented as P times the price of investment goods times investment quantity. Asset price turnover. Asset bubbles such as rising house or equity prices increase the need for financing due to higher turnover and valuation of assets. For example, as the price of capital PK rises, additional funds are required to facilitate transactions involving the existing stock of housing or physical capital. On the right-hand side of the financing equation are deposits, which typically fund normal consumption expenditures. However, for larger items like housing, individuals must rely on bank loans rather than regular deposits, emphasizing the critical role of banks in facilitating large-scale investments. Example 1, money creation. In this example, we illustrate the process of money creation using a graphical representation. The purchase of new or existing physical capital is represented as XIP nyan times I KIXI, where PEMPIPE is the price of new investment goods, e.g. new capital or housing. For existing physical capital such as houses, it is represented as PK times K, where PK is the price of capital and K is the quantity of capital. When individuals cannot finance these purchases through their deposits, they must obtain a loan from a bank. This loan facilitates the creation of money as banks extend purchasing power to borrowers. Incorporating this financing constraint into models is critical for analyzing the mechanics of modern financial systems and understanding money creation dynamics. Example 2. Money destruction. The process of money destruction works as a reverse of money creation. Once a loan is used to purchase an asset, such as a house, the proceeds are deposited into the seller's account. However, if the seller uses these funds to repay an existing loan, both the loan and corresponding deposits are reduced, effectively destroying money within the banking system. While this is not the typical outcome, money often remains in the economy, allowing leverage to grow over time. It becomes significant during financial downturns. For instance, during the global financial crisis or the ongoing issues in China's property sector, excessive debt levels led to widespread loan repayments, reducing purchasing power and economic activity. Understanding this interplay is crucial as modern financial systems often underprice the risk of excessive credit expansion, contributing to asset bubbles and systemic vulnerabilities. MAPMOD, a model with endogenous credit default risk, incorporates critical features of modern financial systems. One, borrower behavior. Borrowers use bank loans to finance consumption and investment secured against their assets, such as houses, physical capital, or equities. 2. Asset prices and defaults. Defaults occur as a function of ex-post asset prices. For example, if a house purchased for $100,000 with a 95% loan-to-value ratio, $95,000 loan drops in value below $95,000, the borrower may enter negative equity. In such cases, defaults or bankruptcies are more likely, driven by common aggregate factors, e.g., an asset price bubble, rather than idiosyncratic risks. 3. Aggregate risk and asset price bubbles. The U.S. household balance sheet, historically considered one of the least risky globally, now exhibits vulnerabilities due to a significant asset price bubble. This bubble poses systemic risks that cannot be diversified or insured against, as its scale exceeds the capacity of any entity to mitigate it. Banks in MAPMOD do not rely on trading books. They primarily hold loan books, emphasizing credit risk over liquidity risk. Their ability to expand balance sheets is constrained by capital adequacy regulations, which account for the ex-post realized values of their assets, liabilities, and equity. Key bank activities include 1. Borrower assessment. Banks evaluate the assets of potential borrowers to verify their value and risk profile. This evaluation determines the individual lending supply curves, which reflect the terms on which loans are offered. 2. Capital constraints. Banks adhere to minimum capital adequacy ratios, limiting their capacity to expand credit indiscriminately. This regulation ties back to systemic risk management and ensures that banks maintain sufficient equity to absorb losses. By integrating these dynamics, MAPMOD provides a robust framework for analyzing the interplay between asset prices, credit availability, and systemic risks in modern economies. The model introduces two critical non-linearities that shape the behavior of banks and the broader financial system. 1. Individual lending supply curves. Banks assess individual borrowers and determine lending spreads based on the perceived risk of the loan. These lending spreads are closely tied to the loan-to-value or LTV ratio. As the LTV ratio increases, so does the lending spread, reflecting higher risk. This mechanism mirrors the concept of a financial accelerator as outlined by Bernanke, Gertler, and Gilchrist, where credit conditions amplify economic cycles. Optimal loan portfolio size. Banks also consider the overall size of their loan portfolio. They evaluate whether maintaining a large portfolio exposes them to excessive risk in adverse economic conditions. The objective is to balance profitability against potential vulnerabilities that could emerge during economic downturns. The relationship between lending spreads and LTV ratios is inherently nonlinear. This curve is convex, meaning lending spreads rise more sharply as LTV ratios approach critical levels. Several key points highlight this nonlinearity. Aggregate and idiosyncratic risks. Lending spreads are influenced by a combination of aggregate, systemic risks, and borrower-specific idiosyncratic risks. Banks adjust credit availability and pricing to account for these risks, with lending conditions tightening for higher-risk borrowers. Real-world observations. For example, during the housing bubble in Ireland before the financial crisis, banks issued loans exceeding 100% of the property value, with LTV ratios reaching as high as 110%. In such cases, lending spreads remained flat or underpriced, failing to reflect the true risk of these loans. This underpricing of risk often sows the seeds for financial crises. Crisis dynamics. Before financial crisis, lending spread curves tend to be flatter, signaling lax credit standards. During crisis, these curves steepen dramatically as risk is repriced, and banks retreat from high-risk lending. The second fundamental nonlinearity involves the relationship between lending spreads and the bank capital adequacy ratio. Key dynamics include avoiding regulatory scrutiny. Banks aim to stay well above the regulatory minimum capital adequacy ratio, e.g. 8%. Falling close to this threshold triggers increased regulatory oversight, as seen during the global financial crisis when regulators demanded asset sales from banks like Citibank. Distressed asset sales. In crisis conditions, selling assets to meet capital requirements becomes problematic, as asset prices are often deeply distressed. Banks are reluctant to sell assets at such valuations, especially if those assets are central to their business models. This creates an incentive for banks to maintain adequate capital buffers. The underpricing of risk significantly impacts the behavior of the two curves described above. One, shift in lending spread. Curve when risk is underpriced, the lending spread curve flattens, allowing credit to flow to higher risk borrowers. This increases the probability of asset bubbles and financial instability. To capital adequacy risks, banks with underpriced risk are more likely to approach the regulatory minimum capital adequacy ratio. This heightens their vulnerability in adverse economic conditions, as they may be forced into distressed sales or other corrective actions under regulatory pressure. These two nonlinearities, lending spreads tied to LTV ratios and capital adequacy ratios, highlight critical dynamics in modern banking systems. They underscore the importance of understanding how risk is priced and managed, as well as the systemic implications of deviations from prudent lending and capital management practices. Proper regulation and risk management are essential to mitigating the vulnerabilities that arise from these nonlinearities. In this analysis, we explore shifts in two critical curves that represent banking behavior. 1. Left curve, lending spread and loan-to-value ratio. When lending spreads do not rise proportionally with the loan-to-value LTV ratio, it suggests an outward shift in the Bernanke-Gertler-Gilchrist financial accelerator curve. This occurs when banks extend credit at favorable terms even as risks increase. For example, during pre-crisis periods, mortgage loans were issued without appropriate adjustments for rising LTV ratios. 2. Right curve, capital adequacy and risk aversion. On the right-hand side, the financial accelerator captures how banks approach the minimum capital adequacy ratio. Banks might edge closer to this threshold, reducing their capital buffers and increasing systemic risk. Both shifting and moving along these curves pose risks of unleashing a financial crisis by amplifying adverse interactions between financial conditions and the real economy. We differentiate between good and bad credit expansions by their drivers and outcomes. 1. Good credit expansion, productivity growth. A good credit expansion stems from expectations of higher productivity growth. For instance, in the early 2000s leading up to 2007, the United States experienced an increase in potential growth by over 1 percentage point, driven primarily by productivity gains. In such scenarios, households and firms anticipate better economic prospects, prompting increased consumption, investment, and credit growth. 2. Bad credit expansion, underpricing of risk. A bad credit expansion results from the financial system underpricing risk, as observed before the global financial crisis and in China today. These expansions involve overly optimistic expectations of fundamentals, coupled with lax credit standards. When risks materialize, the combination of excessive optimism and underpriced risk leads to financial crises. 3. A very bad credit expansion, combining both factors. The most severe crises occur when productivity expectations are overly optimistic and risks are underpriced. This combination was evident in 2009-2010, where these nonlinear dynamics created the global financial crisis. Nonlinearities play a critical role in amplifying these effects, leading to widespread economic disruptions. The model also examines how counter-cyclical macroprudential policies can address financial vulnerabilities. 1. Higher capital adequacy ratios. Imposing higher capital requirements can stabilize financial systems, but also poses trade-offs. In the long run, higher capital adequacy ratios may reduce credit availability and economic growth. Experiments explore the dynamic effects of announcing versus surprising the market with such policy changes. 2. Effectiveness of policies. The results show that well-designed macroprudential policies can mitigate the seeds of financial crises, particularly by addressing excessive risk-taking and ensuring that banks maintain adequate capital buffers. The analysis also highlights the importance of nonlinear financial models, particularly those incorporating financial accelerators and endogenous money creation. 1. Expectation-driven cycles. When households, firms, and policymakers expect higher productivity growth, modern financial systems enable faster adjustments to new steady states by expanding credit and facilitating investment. 2. Linear versus non-linear models. Linearizing models with financial accelerators may oversimplify critical dynamics, such as how small changes in expectations or risk pricing can lead to disproportionately large economic effects. Non-linearities provide a more accurate representation of these relationships. In a modern financial system, shocks to productivity, particularly in traded goods sectors, drive economic cycles. 1. Credit expansion and consumption investment dynamics. With expectations of higher future productivity, households and firms increase consumption and investment today. Banks respond by extending credit at favorable terms, lowering lending spreads, and supporting economic growth. 2. Key observations from the model are: in the scenario, GDP rises approximately 10% over 10 years, reflecting the transition toward a new steady state. Banks expand real credit rapidly, reducing lending spreads by 30 basis points as they perceive loans to be low risk. Banks maintain a post-default capital adequacy ratio of 11.5%, exceeding the regulatory minimum of 8%. This buffer allows them to continue lending during favorable economic conditions. Higher productivity expectations drive up the price of capital as physical capital adjusts gradually over time. 3. Artificial intelligence and future productivity. While technologies like artificial intelligence and robotics may raise productivity, their impact is unlikely to rival transformative technologies like electricity, at least in the near term. AI is better thought of as a labor-saving technology that increases efficiency in specific tasks with potential for greater breakthroughs in the future. This analysis illustrates the dynamics of credit expansions, financial accelerators, and modern financial systems. Whether driven by genuine productivity growth or underpriced risk, credit expansions have profound implications for economic stability. Understanding these dynamics, particularly the nonlinearities at play, is crucial for policymakers and economists aiming to design resilient financial systems. 1. Good credit expansion, higher productivity growth. In the first scenario, higher productivity growth over a 10-year period drives a significant economic expansion. Key outcomes include increased consumption, investment, wages, employment, and real incomes. Banks facilitate this adjustment by extending credit, enabling the economy to transition smoothly to a new steady state. These outcomes align with what we observe in real-world economies during periods of sustained productivity growth. In this phase, financial system variables respond to the productivity shock, asset price growth. Rising asset prices reflect improved economic fundamentals. Low lending spreads. Credit is extended at favorable terms, boosting real credit growth. Banks reduce capital buffers, confident in the profitability and low-risk nature of their loans. This confidence drives an increase in credit availability. In an open economy, additional dynamics emerge. Productivity-driven supply increases outpace demand, leading to falling inflation. Real exchange rates appreciate due to productivity improvements, influenced by factors like the Balassa-Samuelson effect. Central banks might maintain low interest rates in such a scenario, as inflationary pressures remain subdued. However, the specific monetary policy response depends on the model's assumptions and the type of shock. A bad credit expansion unfolds when expectations of long-term productivity growth are revised downward after 3 years. Key aspects include productivity growth over the first 3 years leads to a 3% permanent increase in output. The remaining 7 years of expected productivity growth fail to materialize, leading to an economic adjustment. Banks and households, having built up excessive leverage during the initial period of optimism, face significant vulnerabilities. The bad credit expansion mirrors real-world scenarios such as pre-2008 dynamics in the US. Low real exchange rates and Chinese financing of the US current account deficit contributed to rising real incomes and asset prices. Optimistic expectations led to higher leverage and inflated asset prices. When expectations were revised, the result was a financial crisis marked by nonlinear interactions between real and financial variables. When expectations are corrected, the economy undergoes a severe adjustment. Real GDP contracts and asset prices, including equity values, experience significant declines. Typically, smooth variables like consumption and investment crash, reflecting the severity of the financial adjustment. Banks tighten credit conditions, increase lending spreads up to 120 basis points in this case, and cease issuing high-risk loans, exacerbating the downturn. A second bad credit expansion scenario involves systemic underpricing of risk. Ninja loans were extended to individuals with no income, job, or assets, reflecting a lack of financial supervision and widespread malfeasance. Aggregate macroeconomic data often fail to reveal the underlying risks during periods of excessive optimism and underpriced risk. After 3 years, banks recognize their mispricing of risk, triggering deleveraging and a vicious feedback loop between real and financial variables. In both bad credit expansion scenarios, the economy enters a deleveraging cycle. Tight credit conditions, falling asset prices, and declining GDP reinforce one another in a feedback loop. The same qualitative patterns, sharp economic contractions, collapsing consumption, and tighter financial conditions are observed across different types of financial crises. During the first 3 years of a credit expansion driven by productivity growth, GDP, consumption, and investment all rise, real credit growth is strong, lending spreads are low, and banks reduce capital buffers to extend more loans. Asset prices remain high, physical capital stock grows, and external debt increases as the economy borrows from foreigners. Inflation rises, prompting higher interest rates. However, the focus remains on the broader financial cycle and macroeconomic interactions rather than monetary policy specifics. The impact of underpricing risk. After the initial 3 years, banks recognize they have underpriced risk. Key outcomes include the real value of the capital stock falls slightly, while the impact of underpricing risk appears modest when confined to the banking sector alone. The implications could be far greater if this underpricing leads to broader asset price bubbles. If the underpricing of risk is linked to a massive asset price bubble, the consequences could exceed those of the global financial crisis. Policymakers must remain vigilant in assessing incremental risks within the broader macroeconomic context. The next scenario combines two factors, overly optimistic growth expectations and the underpricing of risk. This results in a nonlinear financial crisis. GDP falls dramatically from plus 5% at its peak to 2%, a 6 percentage point swing mirroring real-world crisis. Investment plummets from plus 15% to 3%, an 18 percentage point decline. The BA spread rises by 300 to 400 basis points, reflecting heightened financial stress. The magnitude and pattern of these shifts align with dynamics observed during events like the global financial crisis. That's all for this part. See you.